There's no misleading clickbait here, just a real strategy that's being used by thousands of investors right now to double, triple, and continuously grow their wealth. Today on Trade Savvy Academy, we're diving into a powerful investing method that doesn't rely on stock picking or timing the market. We're talking about building wealth through ETFs, specifically through a dividend reinvestment strategy that uses compounding and cash flow to work for you day and night. This is how real investors double their money and keep doing it. Now, I want to be crystal clear from the start. This isn't a get-rich-in-30 days gimmick. You won't see Lambos or day trading setups here, but you will see a simple, repeatable strategy that investors have used over the past decade to consistently double their money without stress. And today, we'll break down exactly how it works using 3 powerful ETFs with a track record of performance, income, and reliability. We'll look at their historical returns, dividend yield, DRIP potential, and how long it could realistically take to double your money in each one. The core strategy: simplicity plus reinvestment equals wealth. Here's the strategy in a nutshell. Invest in high-quality ETFs that generate income and long-term growth. Reinvest all dividends and stay consistent. That's it. The key is compound interest and time. And with today's technology, you can automate all of it. Whether you're investing $500 a month or $5,000, the results over 5, 10, or 20 years can be life-changing. But before we dive into the individual ETFs, I want to introduce you to something called the Rule of 72, a simple yet powerful formula used by investors and financial planners to estimate how long it takes to double your money. Here's how it works. You take the number 72 and divide it by your average annual return. The result tells you how many years it will take for your investment to double in value. For example, if you're earning a 10% return annually, just take 72 divided by 10 and you get 7.2 years. That means your investment will roughly double in just over 7 years, without adding a single extra dollar. The Rule of 72 isn't exact down to the decimal, but it's incredibly useful for long-term planning, especially when dealing with compound growth. So throughout this video, we'll be using this rule to estimate how long it would take to double your money if you invested in each of the ETFs we cover. It's a quick and effective way to see the real-world impact of consistent returns and dividend reinvestment. With that in mind, let's kick things off with the first ETF on our list, JEPQ, JP Morgan Nasdaq Equity Premium Income. ETF JEPQ is not your average ETF. It's a covered call ETF focused on the Nasdaq 100. That means it invests in growth-oriented tech stocks like Microsoft, Apple, and Nvidia, but adds a twist. It sells call options on its holdings to generate monthly income. This strategy produces one of the highest consistent yields in the ETF world. Dividend yield. JEPQ currently yields around 11 to 12% annually, paid out monthly. That's significantly higher than traditional dividend ETFs. Historical return. JEPQ is relatively new. It launched in 2022, so we don't have 10+ years of data. However, since inception, it has returned around 9 to 10% annually, depending on market conditions, with most of that coming from income rather than capital gains. Reinvestment potential. The magic with JEPQ lies in monthly compounding. If you reinvest those monthly distributions using DRIP, you're adding to your share count 12 times a year. This accelerates your compounding effect far more than quarterly paying ETFs. Doubling timeline. Using the Rule of 72, let's say you earn a consistent 10% return from yield and modest appreciation. 72 by 10 equals 7.2 years. That means your investment could double in just over 7 years, possibly faster if the market performs well and you reinvest consistently. Ideal for JEPQ is perfect for income-focused investors who want exposure to tech, monthly cash flow, and a reinvestment strategy that can rapidly grow over time. It's a strong choice in a rising interest rate environment or when volatility is high, because those conditions boost option premiums. Before we move on, please don't forget to follow me on X at the handle shown on the screen to see my live trades and investments at no cost. Second, we have VIG, Vanguard Dividend Appreciation ETF, a classic blue-chip ETF that focuses on companies with a proven history of increasing their dividends for 10 years or more. These are your Procter & Gamble's, Johnson & Johnson's, and PepsiCo's of the world. Dividend yield. VIG currently offers a dividend yield of about 2.1%, but here's the trick. It's a growing yield. That means your income tends to increase year after year as the underlying companies increase their payouts. Historical performance. Over the last 10 years, VIG has returned about 10.2% annually, including dividends. It's less volatile than JEPQ or the S&P 500, which makes it a great core holding. Dividend reinvestment effect. Because VIG is all about growth, reinvesting your dividends means you're constantly buying more shares of quality, increasing income companies. This adds up dramatically over time. Doubling timeline. Using the rule of 72, 72 by 10.2 equals just over 7 years to double your money. And since the yield grows, your total return might accelerate even more after year 3 or 4. Best 4. VIG suits long-term investors who prefer stability and a rising income stream rather than high current yield. It's excellent for retirement accounts or anyone who wants to sleep peacefully at night while their investments grow. Next, we have VOO, Vanguard S&P 500 ETF, the foundation of countless successful portfolios. VOO tracks the S&P 500, which includes the 500 largest companies in the US. If you want broad exposure to American business and a simple, high-performance ETF, VOO is it. Dividend yield. VOO yields around 1.3%, so it's the lowest among our three, but you're compensated through higher capital gains potential. Historical return. Over the last 10 years, VOO has returned an average of 12.1% per year. That's higher than both JEPQ and VIG, primarily due to the performance of companies like Apple, Microsoft, Amazon, and Tesla. Doubling timeline. 72 by 12.1 equals about 6 years to double your money. That's the fastest on this list. Drip advantage. Even though the dividend is smaller, it still adds a compounding effect, especially in down markets when you're reinvesting at cheaper prices. Best 4. VOO is ideal for investors who want growth, diversification, and minimal effort. If you only picked one ETF for the next 20 years, VOO would be an extremely strong contender. How dividend reinvestment changes everything. Let's talk about why DRIP, dividend reinvestment plans, are so important. When you turn on DRIP in your brokerage, every dollar in dividends you receive gets reinvested into buying more shares. Those new shares also pay dividends, and it creates a chain reaction. With JEPQ paying monthly, and VIG and VOO quarterly, your reinvestment schedule starts rolling like a snowball, and that's exactly how wealth is built. Here's a quick example. If you invest $500 per month into JEPQ with an 11% return mostly from dividends, you could end up with over $104,000 after 10 years. The same contribution into VIG or VOO could land you anywhere from $95,000 to $110,000, depending on the reinvestment schedule and market return. The trick is starting early, staying consistent, and letting compound interest do the heavy lifting. Let's do the math. Rule of 72 recap. Let's quickly recap our 3 ETFs using the rule of 72. JEPQ, 10% estimated total return. 72 by 10 equals 7.2 years. VIG, 10.2% return. 72 by 10.2 equals 7.05 years. VOO, 12.1% return. 72 by 12.1 equals 5.95 years. So yes, you can realistically double your money in under 6 to 7 years using any of these ETFs, especially with dividend reinvestment. 3-step plan to start doubling your money. So how do you put all this into action? Step 1. Choose the ETFs that fit you best. Want income? Go with JEPQ. Prefer growing dividends and stability? Pick VIG. Looking for total market growth? VOO is your best bet. Or better yet, create a balanced mix of all 3. Step 2. Automate your contributions. Set up monthly auto investments. Whether it's $100, $500, or $1,000, automate it. Remove emotion. Just keep adding. Step 3. Enable DRIP in your brokerage. Most platforms like Fidelity, TD, Wealthsimple, Vanguard, and Schwab let you turn on DRIP in a few clicks. Once it's active, your snowball is officially rolling. My final thoughts. This is how you actually build wealth. Listen, most people overcomplicate investing. They chase hype. They buy random stocks based on headlines or TikTok trends. But the wealthiest investors use systems, and this ETF strategy, powered by compounding and dividend reinvestment, is a system that works. Whether you're in your 20s or your 50s, this approach scales. You can double your money in 6 to 7 years, then do it again in even less time, because now you're compounding on a larger base. This is how everyday investors become financially independent without stress, drama, or sleepless nights. If you got value from this video, do me a favor, like, subscribe, and drop a comment below telling me which of these ETFs you're buying right now. JEPQ, VIG, or VOO, or maybe all three. This is Ricky from Trade Savvy Academy, and I'll see you in the next one, where we take smart investing and turn it into long-term wealth. Until then, keep building, keep reinvesting, and keep your money working as hard as you do.